It was October 29th, 2008. The market was in chaos. The Dow had just fallen 700 points in a single day, and every trader I knew was glued to their screens. One of my friends called me in a panic. He had just wired half his life savings into his broker account because a can't-miss timing signal had flashed green. It wasn't moving averages. It wasn't earnings reports. It was a lunar cycle pattern claiming market surged 2 days after a new moon. That morning, the moon was perfect. The setup was perfect. His conviction was perfect. But, by the closing bell, he was down 32%. Instead of cutting the loss, he doubled down, convinced the signal was late. The market kept falling. Here's the thing. This wasn't just about the moon. It was about something far more dangerous than any bad strategy. It was about the way our brains desperately search for order in pure randomness. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here, we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm competence. Because, in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. Because one insight today could change how you trade forever. Years ago, I read a book that permanently changed the way I see the markets. A Random Walk Down Wall Street by Burton Gordon Malkiel. Malkiel makes a simple but uncomfortable claim that no matter how much we analyze, chart, or backtest, most price movement is, in fact, random. And yet, human nature hates that idea. We want order. We crave patterns. We need to believe we can predict what comes next. That's why traders chase signals, from sunspots to moon phases to vibrations on a fault line. It's why even the most rational investor can cling to a system long after it's failed. Because deep down, we'd rather believe in a false sense of control than accept the truth of randomness. It was 2013, and I thought I'd finally cracked the code. I'd built a system, a mashup of technical indicators, seasonality patterns, and a volatility filter that made me feel like I could see the market's next move before it happened. It wasn't based on moon phases, but looking back, it might as well have been. The system had worked beautifully for 6 months. Every backtest looked bulletproof. And I convinced myself I was in complete control. One Monday morning, my perfect setup flashed. All signals aligned. The position size? Large. Too large. Because when you believe you can predict the market, your risk discipline quietly slips. The first hour looked fine, small gains. Then, without warning, a sharp reversal hit. No economic report. No earnings shock. Just pure market randomness. I told myself, it's just noise. The signal says it'll reverse back in my favor. It didn't. By the close, the loss was deep, one of my largest in years. I realized something that day. I hadn't been trading the market. I had been trading my belief in the market. And that's exactly what Malkiel warns about. The danger of mistaking short-term success for predictive skill. The trap where we confuse process with outcome and think the market is rewarding our brilliance, when in reality, it's just flipping a coin. That single day taught me more than 100 profitable trades ever could, that any system built on the illusion of prediction will eventually fail, and if your process depends on always being right, it will take you down with it. That loss forced me to face something I'd been avoiding. I wasn't really managing trades, I was managing my need to be right. Today's talk is about that dangerous comfort we all chase, the belief that we can predict the market. How it pulls us into risk we can't see, how it disguises randomness as skill, and how it can quietly destroy even the most disciplined trader. What I'm about to share isn't financial advice. It's simply what I've learned, from my own scars and from mentoring traders who've fallen into the same trap. If you can recognize this pattern in yourself and break it, you can change the way you trade forever. Trying to predict the market is like trying to catch a falling knife while blindfolded. You might grab the handle once or twice, and that tiny taste of success will make you believe you've got the skill. But sooner or later, you grab the blade. And when that happens, it's not just your account that bleeds, it's your confidence, your discipline, and your ability to trade without fear. One of the most important points Malkiel makes is this: human nature hates randomness. We look for patterns everywhere. in stock charts, in sports scores, even in coin flips. It's called apophenia, our brain's tendency to see order in chaos. And in trading, it's a double-edged sword. I've mentored traders who could rattle off the last 20 days of SPX moves from memory. They'd swear there was a rhythm: up 2, down 1, up 3, flat, repeat. They believed the market was leaving clues, like breadcrumbs in the woods. The more they saw the pattern, the more they believed in their ability to predict. Here's the trap: confirmation bias. Once you think you've found a pattern, your brain selectively filters evidence to prove it's real. You ignore the times it fails and overemphasize the times it works. Behavioral finance research backs this up. One famous study found that when people were shown a completely random sequence of coin tosses, over 80% swore they could detect a trend. The key finding: the more confident they became, the worse their predictive accuracy actually got. That's exactly what Malkiel warns against, that most price moves are noise. And yet, like a gambler seeing faces in the cards, traders will bet hard on their pattern until the market proves them wrong, usually with real money. Why? This resonated with me. When I first read that chapter, I had flashbacks to the early days of my career. I had a favorite chart pattern, a triple tap into resistance, followed by a sharp breakdown. For a while, it worked beautifully. Then one month, I noticed it failing more often. Instead of questioning the pattern, I convinced myself it was a timing issue. I just needed to enter earlier, or later, or use a bigger stop. I was chasing the ghost of a pattern that wasn't really there. The psychology-linked pattern hunting satisfies our brain's need for certainty. It feels safer to think, I've seen this before, I know what happens next, than to accept, I have no idea what happens next. But markets don't care about your comfort. And the more you rely on that comfort, the more you drift away from true risk management. The fix: if you catch yourself saying, I know this move, it's just like last time, stop. Ask yourself, do I have actual statistical proof this pattern works, or am I just remembering the wins? Run the numbers, backtest objectively. And here's the key: track every instance of the pattern, not just the ones that worked. When you start doing that, most patterns dissolve under the light of truth. And that's a good thing, because once you strip away the illusions, you can start building systems based on real probabilities, not perceived ones. This week, pick one pattern you trade. Audit it. No filters. Look at every occurrence in the last 2 years. Write down the win rate, the average win, and the average loss. Then ask yourself, would I still trade this if I knew these numbers before I ever took it? Malkiel points out something that's easy to miss. Even if a method works for a while, the moment too many traders use it, its edge evaporates. By the time most people see the signal, the move has already happened. He calls it missing the boat. But here's the dangerous twist. When we do catch a move early, our brain locks it in as evidence that we can do it again. That's overconfidence, and its close cousin, the illusion of control. I remember talking to a trader who nailed a perfect entry in Apple during an earnings run. Right before the breakout, he sized up double his normal risk, caught the wave, and booked a monster profit. That single trade became his mental reference point. He started thinking, I can read the tape better than most. He stopped journaling every trade. Risk rules got flexible. And one day, he tried to front-run a signal on Tesla, thinking it was the same setup. It wasn't. The loss wiped out 2 months of gains. Behavioral finance research confirms this is common. One University of California study analyzed more than 60,000 retail brokerage accounts and found that the most active traders, often the most overconfident, underperformed the market by 6.5% per year. Why? They traded more often, sized up too aggressively, and underestimated risk. I've fallen for this myself. After a strong streak in 2017, I started skipping steps in my pre-trade checklist. My logic was, why waste time? I've seen this setup 100 times. But the market doesn't care how many times you've seen it. It only cares what's happening now. And now can change in an instant. Why? This resonated with me. When Malkiel talks about the value of any technique depreciating as more people use it, I realize this isn't just about signal saturation. It's about personal bias saturation. The more a strategy proves itself to you, the more blind you become to the ways it can fail. Overconfidence is seductive because it feels like mastery. Your wins confirm your self-image as a skilled trader. And skill does play a role, but in the market, skill without humility is a ticking time bomb. What's the fix? If you've just had a big win, ask yourself, how much of that was skill and how much was the market's randomness? Force yourself to write down both factors. Then commit to trading your next setup at normal size, no exceptions. I tell my clients to keep what I call a humility log. Every time you're tempted to break your rules because this setup is different, write it down and explain why. When you look back at those entries months later, you'll often see that the trades you were most certain about were the ones that hurt you most. For the next 2 weeks, trade as if every setup you see is just one coin flip in 1,000. Same size, same process. Win or lose, move on. If you can't resist the urge to go big on one trade, you're not running your system, your ego is. Malkiel warns that sharp reversals in the market can happen so suddenly that, by the time your system flashes by, the move is already gone. That's the cruel irony of many technical systems. They're designed to protect you from false moves, but in doing so, they often confirm after the profit is over. I saw this firsthand during the 2020 pandemic crash. A trader I helped was using a trend-following breakout system. It required 3 days of confirmation before entering. In normal conditions, it filtered out noise beautifully. But in March 2020, volatility was so extreme that by the time her system said it's safe, the market had already rebounded 12% from the lows. She bought in, thinking she was catching the start of the uptrend. The next day, a sudden reversal took back half those gains. No news, no earnings, just market whiplash. The problem wasn't just her system's lag. It was the belief that a late but confirmed entry is always safer. Sometimes it is. But in a high volatility environment, confirmation can be nothing more than a delayed invitation to the slaughter. Malkiel also points out a second layer to this trap. Once a technique becomes popular, traders start front-running the signals. They want to be early. But when everyone does that, the move happens before the signal ever fires. Then the system's followers are left holding positions at the very moment the early entrants are taking profits. Why? This resonated with me. Early in my career, I relied on a 50-day breakout system. It worked great in stable markets. But in fast, news-driven markets, it felt like chasing a bus that had already pulled away. The worst part? I'd get stopped out right before the original breakout level held and ran without me. It wasn't that the system was bad, it was that I was applying it without considering context. The psychology link. This is a mix of process versus outcome confusion and loss aversion. We convince ourselves that following the signal exactly as designed will protect us from loss. But when losses still happen, the pain feels worse because we played by the rules. That pain tempts traders to tweak or abandon the system entirely, often right before it starts working again. The fix: know your system's reaction time. Measure how much price tends to move between signal and entry. If it's consistently too slow in certain conditions, either accept that limitation or adapt the rules for volatility spikes. But never blindly assume that confirmation equals safety. A trading system is like a seatbelt. It saves you in most accidents, but it won't help if you only click it in after the crash has started. Review your last 20 trades that came from a confirmed signal. Ask, how much did price move from the first trigger to my actual entry? Did that delay improve my odds, or just cut into potential gains? If the delay hurt more than it helped, it's time to rethink how your system handles speed. At some point in my career, I realized my trading was built on a quiet assumption that my job was to predict where the market was going. It's what most traders think. It's what most books imply. But the truth is, you don't need prediction to be profitable. You need process. When I stripped prediction out of my trading, everything changed. No more obsessing over whether I was right. No more all-nighters tweaking indicators for an extra 2% backtest gain. Instead, I started focusing on 3 things: defining my entry criteria clearly, defining my exit criteria clearly, keeping risk per trade constant, no matter how good the setup looked. This is where Malkiel's message clicked for me. If most short-term price moves are random, then my edge can't come from calling the next move. It has to come from managing the trade once I'm in it, controlling size, controlling losses, and letting winners run. I remember talking to a trader who couldn't stop forecasting. Every morning he'd open with, "I think the market's going to rally today because," and every time he was wrong, it threw him off balance. We rebuilt his approach from the ground up. Instead of "I think," his pre-market prep became, "If X happens, I'll do Y. If not, I'll do nothing." Within 3 months, his win rate didn't just improve, his stress levels dropped in half. Why? This resonated with me. In one chapter, Malkiel emphasizes that investors should weigh their alternatives, like interest rates, instead of seeing the stock market as an isolated world. That's process thinking. It's looking at conditions, not just predictions. And it's liberating when you realize you don't have to call it to trade well. The psychology link. This dismantles ego and identity traps. When your success isn't tied to being right, your self-worth no longer swings with your P&L. It also crushes impatience, because you're not constantly hunting for the next big move, you're waiting for the conditions you've predefined. Write your process down. Every step. So that anyone could pick it up and execute your trades exactly as you would. If you can't do that, your system isn't a system, it's just you making it up as you go. This week, don't predict a single market move. Only react to predefined triggers. No, I think. Only if X, then Y. And see how it feels when your results aren't tied to your crystal ball, but to your discipline. One of the most famous studies in behavioral finance comes from Daniel Kahneman and Amos Tversky, the pioneers of prospect theory. They found that the pain of a loss is felt 2 to 2.5 times more strongly than the pleasure of an equivalent gain. This single bias, loss aversion, explains why traders cling to prediction systems. If you know the market is going up, you feel safe. That safety dulls the pain of potential loss, even if the belief is an illusion. Another large-scale study by Barber and Odean examined over 60,000 retail brokerage accounts. They discovered that the most active traders, often the most overconfident, underperformed the market by 6.5% annually. Why? Too much trading. Too much sizing up when certainty was high, and too much belief in their own ability to predict. History backs this up. In the late 1990s, day traders piled into internet stocks using breakout patterns that seemed bulletproof. For months, the signals worked, until they didn't. Once enough traders anticipated them, the breakouts started failing faster, triggering cascade losses. Many of those traders weren't bad analysts. They were victims of self-defeating popularity. Even in the 2020 COVID crash and recovery, the same pattern emerged. Traders who predicted "we'll retest the lows" stayed out of the rally entirely. Meanwhile, process-driven traders simply followed their setups, and many rode the wave without needing to guess the macro outcome. The takeaway? Prediction is emotionally comforting but statistically dangerous. Process may feel less heroic, but over time, it wins not by calling the market, but by surviving it. After mentoring hundreds of traders, I've noticed the same psychological traps appear again and again. 1. Overconfidence and illusion of control. A winning streak convinces you that you are the edge, not your process. You start breaking your own rules, certain you can read the market better than everyone else. This is when risk discipline quietly erodes. 2. Confirmation bias. Once you spot a pattern, your brain starts filtering for evidence that it's real. You see the wins, you forget the losses. It's why traders keep chasing a broken signal long after it stopped working. 3. Process versus outcome. Confusion. You think a win means your process is good, and a loss means it's bad. In reality, good processes can lose, and bad processes can win in the short term. The danger is letting short-term results dictate long-term behavior. The traders who break these patterns, they're the ones who accept randomness, stick to a defined process, and treat every trade as one event in a long series, not a personal referendum on their skill. If you want to break the prediction habit, you need tools that pull you back to process. 1. The if X, then Y playbook. Before the market opens, write down your triggers and actions. For example, if price breaks above yesterday's high with volume 20% above average, then enter long with half size. If price closes below the 20-day moving average, then exit half position. No predictions, just conditions. 2. The pattern audit. Take your favorite setup. Backtest it over the last 2 years. Log every occurrence, wins and losses, record win rate, average win and average loss. This removes the emotional memory bias that makes patterns seem more reliable than they are. 3. The humility log. Every time you're tempted to size up or skip a rule because this one's different, write it down. 3 months later, review the trades that came from those moments. You'll see how often your certainty was wrong, and that awareness will save you in the future. 4. Fixed risk per trade. Pick a dollar amount or percentage and make it law. Never break it, not for any setup, no matter how perfect it looks. Consistency here forces discipline elsewhere. These tools aren't exciting. They won't give you the rush of calling the top or nailing the bottom. But they will keep you in the game, and that's the real win in trading. Take a moment and ask yourself, how many of my trades last month were based on a defined process versus a prediction? If my favorite setup stopped working tomorrow, would I notice right away or keep trading it until the losses piled up? Do I size my trades based on a fixed plan, or do I go bigger when I feel certain? When I lose, do I review my process or my ego? Be brutally honest. Because the market doesn't care what you believe. It cares about what you do. If these questions make you uncomfortable, good. That discomfort is your edge calling. It's telling you exactly where randomness is still in control of your trading. You can't erase that randomness, no one can. But you can stop letting it push you into overconfidence, poor risk choices, and emotional decision-making. And the sooner you do, the faster your trading becomes about execution, not ego. Here's my challenge to you. Right now, before you take your next trade, write down the single biggest lesson you've pulled from this talk. Post it in the comments. Not just for me, but so other traders can see it, relate to it, and learn from it. If you know someone who's struggling, someone caught in the loop of trying to call the market every day, share this video with them. It might save them years of frustration and maybe a few zeros in their account balance. And if this resonated with you, like, share, and subscribe so you don't miss the next one. We're building a community of traders who trade with clarity, not chaos. Because when you master the mental game, you master the market game. Master your mind. Master the market. Trade with confidence and live with calm.